Hello, everyone. Welcome back to Financial News with Channel 4 in Palos Heights. Today is June 7th, 2022, and I'm Ron Jankowski with Channel 4. My co-host, Paul Munichel with Ameriprise Financial. And Paul is going to give us an update what took place last week. And when you're finished, Paul, I'll give you a report as to what Ameriprise had shared with us as of this morning.
Great, thanks. Today I'm going to kind of recap last month's activity. And it's actually hard to believe that last month's May's markets were, for the most part, unchanged. It's difficult to believe with the roller coaster ride we had. But if you look at the data, major U.S. stock averages were little changed in May, which investors should maybe greet as a positive, considering how the month started out and how the year has progressed. The S&P 500 briefly traded down to a bear market territory intraday on May 20th. Now, bear market being defined by a 20% drop from a recent high. But it failed to close at the official threshold. So the broad-based stock benchmark turned the corner shortly after and actually gained about 8% between May 20th and the close of the month, finishing May less than 1 point higher than where it began. Now, investor concerns regarding Federal Reserve policy tightening and near record inflation levels did weigh on sentiment, which kept stocks mainly on the defensive through most of the month of May. As a result, talk of a possible recession in the U.S. gained more attention. However, the peak inflation narrative started to build steam in the back half of May, with updates on the Consumer Price Index, the CPI, and the Producer Price Index, the PPI, and the Personal Consumption Expenditure Price Index, also known as the PCE, they all showing mixed but moderating price pressures. In addition, average hourly earnings in the April employment report also came in a little softer than March levels, which did help to counter the more downbeat assessments on inflation coming into the month. For the recent rally across stocks to continue, we kind of believe that investors will be looking for more evidence of moderating inflation pressures and that growth is slowing but remaining positive. Inflation, manufacturing, services activity, employment trends, and consumer sentiment behaviors will likely be critical data to watch, which should help inform the path for stocks this month and beyond. So there's a lot to check into there, some decent news that maybe this could be coming to a close, but no clear sign of it yet. We just, as always, got to kind of wait and see.
I wouldn't hold my breath on that one. As of this morning, Ameriprise had shared this, and I'm sure you have some comments to make on this, Paul. U.S. stock futures are lower this morning after Target cut its profit guidance for the second time in 2 weeks. So retail is getting...
We're seeing that where companies are altering their projected earnings and their forecasts and things of this nature. And of course, the market doesn't like it when companies don't hit their numbers.
Right.
So that's not
they're
unexpected.
getting concerned, I'm sure. Markets in Asia closed mixed with China flat, while Europe is broadly lowered by 1% midday.
They're ahead of us, so if they're lower, I mean, that
Yeah.
might be an indication of what we might do today.
Yep.
But our market is different than theirs, but it's just an indication.
Sometimes there's a carryover of that sentiment. Treasury yields are lower this morning. I'm sure you're going to have some comments about this, but Monday's big move up in yields pushed everything on the curve past 5 years over 3%.
Yep, so interest rate yields went up, which kind of spooked the market a bit, but I think you just said they were down a little bit this morning, so maybe starting to regulate a bit.
And Bitcoin futures are under pressure, down over 6% and back below $30,000. WTI crude and gold are mostly flat. So with WTI crude not moving downward. We're not going to see any relief at the gas pump unless something's going on that we are not aware of.
Probably not. There's multiple factors
Yes, there is.
causing those gas prices to be what they are,
Yep.
and
What the president can do and can't do, it has impact on it as well. Well, the year-to-date market index returns, they're stating S&P 500 is a minus 12%, Dow Jones is a minus 8%, and NASDAQ year-to-date minus 22%. And nothing's changed in the last few weeks.
yeah, I mean
with
that's
those index.
still down on the year. Still got a lot of ways to go to get back to positive, but hopefully we may be getting towards a point where the market starts to turn. But we gotta just wait and see.
All right, Paul, thank you for that. Stay with us. Paul has a topic for the Your Money Show coming up next. Stay with us. We'll be right back. And thank you for coming back with us on our show called Your Money. This is a very interesting topic. I personally have interest in knowing what Paul has to say about the Fed rates. What does this mean for you that they are going to be increased? And we hear that they may be increased a couple more times this year. It may be, maybe even more than a couple. Paul, I'm going to let you take it.
All right, great. You know, the Federal Reserve, we already know they have begun what it says will be a series of interest rate increases in an effort to slow the economy and temper the current surge in the inflation rate. At the start of this year, the federal funds rate stood at near 0%. Now, by May, the Fed moved the federal funds rate 75 basis points higher. So the question is, what does this mean for your money? You know, while the Fed actions directly impact large financial institutions, they also resonate throughout the financial markets. In indirect ways, your personal finances can be affected by Fed policy. So let's go over the 4 ways the Fed's rate hikes in 2022 could impact your bottom line. Number 1, higher borrowing costs. So while the Fed's rate hikes don't directly affect most types of consumer loans, the direction the Fed sets on interest rates tends to carry over throughout debt markets. This could include home mortgages. Adjustable rate mortgages will be the most directly affected as they change in conjunction with general interest rate trends in the market. If you have a fixed rate mortgage, you won't see any change. Automobile loans, now while a variety of factors affect how interest rates are set on vehicle loans, you can expect these rates to increase as well. Student loans. Federal student loan rates are set and should not be affected directly. However, borrowers working with private lenders will likely see rates move higher as they are tied to the Fed funds rate. Number 2, we're going to see modestly higher savings rates. Investors have not earned much in terms of interest on bank savings accounts, money market accounts, or certificates of deposit in recent memory. Now, while it seems reasonable to expect that yields may improve modestly, the change may not be dramatic. Even with historically low interest rates, investors have directed significant sums to these types of vehicles. In the current market environment, some investors still have a desire for such safe haven, high liquidity investments, regardless of the interest rate earned. Point number 3 would be the bond market. The Fed interest rates strategies don't impact the bond market directly, but Fed policy is watched closely by bond investors. This year, along with raising short-term rates, the Fed has also begun reducing the role it plays as a buyer in the broader bond market. That action could lessen demand for longer-term bonds, which can drive up interest rates. Even before the Fed initiated its new policies, the bond market already anticipated the change, and interest rates began moving higher on most types of bonds. And point number 4, the last one we want to make today, looking at the stock market. So the stock market also tends to react to the Fed's news. And with the central bank taking steps to slow the economy, investors anticipated the potential negative effect on publicly traded companies. As a result of this and other factors, stocks lost value at the start of the year. Now, this, with everything going on, we always say it may be a good time, more than ever, to talk with your financial advisor about whether any of the changes we mentioned today should require you to update your financial plan. You can't speak with your advisor and your tax advisor, people that you trust, those type professionals in this type of environment, because there's a lot of volatility, there's a lot going on, and relying on experts to give you some guidance may be some good advice here.
And you should use a professional when you're redirecting your investment portfolio, and your objectives are probably going to be affected if you don't do that. And you make a mistake very quickly with all what's going on. You really have to be a keen investor.
Absolutely, and if you at home are working with an advisor already, that's great. If you're not, or if you want a second opinion to the one you're working with, you can feel free to give me a call and reach out to me directly at 708-226-3412.
Thank you, Paul, for bringing that up. That was very interesting, and I'm sure a lot of small investors were interested in hearing some of your comments.
Small and large alike. This affects
everybody.
Yeah.
It sure does. For Paul Munical with Ameriprise Financial and myself, Ron Jankowski with Channel 4 and Palos Heights, we wish you good investment day.